Good day everyone. Welcome to the series of video tutorial about the introduction to Forex. Here we will be discussing different topics to help understand the basics of Forex trading. To start with, the first video, we will be discussing about the Forex markets in general. Forex is an acronym for foreign exchange market. It is a market where currencies from different countries are valued and exchanged. So whenever an individual or an institution buys one currency and sells the other one in a simultaneous transaction, it is known as a trade. Currency trading always occurs in pairs, where one currency is sold for another. The value of one currency against the other is what is known as the exchange rate. And this exchange rate is determined through the forces of demand and supply. Just to get the gist of how massive these Forex markets are, it is one of the largest markets in the world with a daily trading volume of over $4 trillion, which is many times bigger than all the world stock and futures markets combined. However, until not very long ago, it was an exclusive domain of the big participants such as the banks, corporations, central banks, and other hedge funds trying to profit from the market. These were the big players, who still comprise the bulk of the trading volume. Though lately things have started to change, with the deregulation of the Forex markets in 1990s, coupled with the new internet-based technologies, brokers have been able to form pools of liquidity for retail traders like you and me to have access to the huge opportunity in Forex trading. So who trades Forex? Forex market participants are broadly classified as the big players. These are the central banks of different countries, investments and commercial banks, large corporations, or billion-dollar hedge funds. These are the players who know the ins and outs of markets. They are in for profits, speculations, hedging their currency exposures for imports, trades, to name a few reasons. And then we have the small players, that are the brokers who provide access to retail traders. And there are three potential markets for Forex investors to trade currencies in. These are the spot market, currency futures market, and the currency forward market. We shall discuss each one of them one by one. Starting with the spot market. Spot markets are the largest markets for Forex. It is an over-the-counter market and not exchange traded. What this means is that the currencies are bought and sold instantly at an agreed upon exchange rate. These exchanges are facilitated either by a broker or a bank through the trading platforms. Most of us retail traders only trade in the spot markets. Next we have the currency futures market. Futures are contracts to buy and sell the underlying currency at a fixed price at a fixed date in future. These contracts are standardized in terms of their size, the underlying currency pair, and the expiration date. These contracts are exchange traded and cannot be customized in terms of the position size, settlement details or settlement date, etc., unlike the OTC market. And finally, we have the currency forward markets. Forwards are similar to the futures, with the only difference being that these forwards are customizable. These are not standardized and are privately negotiated agreements between the two parties involved. Forwards are also contracts to buy or sell the underlying currency at a fixed date in future at a price which has been agreed upon today. So in the future, at the settlement date, the forward would be settled at the price which was agreed upon today. With this, we come to the end of our video tutorial. Hope this information was of use for you. Thank you for taking the time to watch this video.